Hello, everybody. Welcome to today's episode of the Daily Dose. Today is Thursday, November 3rd, and the market continued to trend downwards today after that FOMC meeting yesterday. So Powell kind of hinted at a slower rate of hikes, but that the terminal rate could be higher than we originally expected. And maybe that it'll stay there longer than the markets had anticipated. So U.S. stocks fell lower Thursday as Wall Street reeled from assertions by Federal Reserve Chair Jerome Powell that hopes for a policy pivot were, quote, premature after the central bank delivered a fourth consecutive interest rate hike of 75 basis points. I actually thought it was interesting, too. Bank of America came out today and said that 4 consecutive 75 basis point rate hikes is it's unprecedented, and that while the Fed needed to do this to get caught up with inflation, that they believe the Fed is almost there as far as catching up to inflation, and that they're going to have to slow down or else something's going to break. There's going to be a financial accident, I believe is what they said. But they also said that they understand that this isn't going to be easy and that the Fed has a tough job cut out for them. So I just thought that was interesting that Bank of America was saying that, hey, we think they're almost there and they're going to have to slow down soon or something's going to break. So just thought that was interesting. The S&P 500 sank 1.1% after the index plunged 2.5% in the previous session. Its worst loss on a Fed day since January 2021, per Bloomberg data. The Dow Jones Industrial Average hit 150 points, or 0.5%, and the technology-focused NASDAQ Composite was off by 1.7%. Meanwhile, Treasury yields ascended, with the key 10-year note inching toward 4.2% and the rate-sensitive 2-year yield above 4.7%. The U.S. dollar index also moved higher. The S&P 500's 2.5% loss Wednesday marked its 54th decline of 1% or more in 2022. That's just crazy, actually. 54 days of declining 1% or more in 2022. That's just absurd. The worst downside volatility since 2009, according to Compound Advisors' Charlie Bilello. U.S. investors also had their attention on action across the Atlantic, with the Bank of England following suit on the Fed's move, also raising interest rates by 0.75 percentage point. So, Wednesday's increase brings the Fed's benchmark policy rate, the federal funds rate, to a new range of 3.75% to 4%, its highest level since 2008. Although the move came in line with expectations, stocks sank after Powell indicated officials may lift interest rates above the 4.6% previously estimated, signaling further tightening is certain, even after the policy statement implied hikes may be smaller in size. So even though we were expecting the rates to slow down, or the hiking, to slow down over the next couple of months, and the Fed said that or hinted at that's what's going to happen. The fact that they're saying that this could go over the 4.6% previously estimated, that means that it will be a longer period of time before they actually pause and start cutting rates. So even though they're going to slow down the rate of how they're hiking the interest rates, they're going to be hiking for not a lot longer, but longer than what the market had anticipated. So that pushes back any kind of pivot hopes. The market initially viewed the November Federal Open Market Committee FOMC statement as dovish. We actually saw the market start to rally there in the middle of the meeting, but a hawkish press conference caused almost a full reversal of these moves due to comments that the ultimate level of interest rates will be higher than previously expected, and it is premature to think about pausing rate hikes. Economists at the Bank of America, led by Michael Gappin, said. The FOMC's statement also acknowledged the lagged effects of cumulative monetary tightening, suggesting heightened attention by the rate-setting group to concerns over economic growth. So, investors shift their attention now to the all-important jobs report at 8:30 a.m. Eastern on Friday. Figures from the Labor Department are projected to show a payroll gain of 190,000 for October, according to Bloomberg estimates. The print If realized, would mark a drop-off of numbers seen across the pandemic recovery, but reflect still robust hiring, with pre-COVID payrolls averaging 150,000 to 200,000 per month. Powell also said in his speech that, quote, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. So just the fact that they view the labor market as strong and there's not really a lot of unemployment is still low, that from their view, they're still able to push interest rates higher and maybe something won't break. So that's kind of what they're seeing. But overall, just bearish sentiment now in the market after that FOMC meeting. I think there was a little bit of disappointment for some investors that were hoping to get a more dovish Fed, because they were kind of getting that. And then in the press conference, like this article said, it kind of wiped away any of those hopes. So if we take a look at the S&P 500 for today, we are headed back towards this zone of 3660 to about 3580, but my eyes are honestly still set on the 3250. I think the 3250 is a good level. I think that it would make sense for the market to breach these lows and for us to have a real another leg down. I think that we definitely still can have that next leg down. I think there's room for this market to fall, and I think the 3250 is a good next level. So that's what I'm looking at on the S&P 500. The trend is definitely still downwards. We're getting lower highs, so now we have a high, a lower high, a lower high, a lower high, and once again another lower high right here. So bearish technically, we got bearish sentiment and we have bearish fundamentals now with maybe a longer period of high interest rates. So that means more quantitative tightening, a longer period of quantitative tightening. And so I think that means that we could see another leg down for sure. So I wouldn't be surprised to see the 3250 level at some point. So on Bitcoin kind of rallied. We're still just above that 20,000 level. You could almost make another level of support like right here. You definitely could, but I just don't want to have the chart be really clogged up like that. I think these are the most important levels. So it's still in its range. It looks like it's stuck between this low level of support right here and the bottom of our zone. Obviously, Bitcoin's been in this range for like 5 months now. So we're really just keeping an eye on it as far as looking for breaks out of this range to the downside or the upside. To the upside, if we broke, I would be looking at the 28,000, and to the downside, if we broke below, I'd be looking anywhere between 12,000 and 9,000. I know that sounds extreme, but there's really no technical levels of support on the way down until we get to those levels. And Bitcoin's been trading pretty heavily correlated to the market during the sell-off. So if we do see another leg down or a larger leg down in the stock market, it wouldn't surprise me to see Bitcoin break through as well. But I'll wrap it right there. Again, if you like this type of content, please subscribe on YouTube and follow wherever you listen to podcasts. I would really appreciate it. I thank you for listening or watching to this episode. Make sure to stay tuned tomorrow and for the weekend episode. And until next time, thank you for listening.